Okay, let me record a video going over the quiz, given that the school is given that we have to do this online, right? Modigliani and Miller proposition 1 states that firm's value is unaffected by its mixture of debt and equity. So basically what they say is if you don't consider tax and financial or bankruptcy cost or financial distress, then the mix of debt and equity will not have any impact on the company's cash flow, and then the company's value is calculated based on a company's cash flow. So that's why the company's value will not be affected by your capital structure. Second question, fluctuation in a company's operating income represents, this is operating income, right? That's their business risk. Okay. When we talk about financial leverage, we talk about how much debt you have. Business risk represents your daily operations. Financial risk refers to risk faced by equity holder of firms with debt, right? Yeah, this is the right one. So basically, it's not only equity holder, some debt holder too, depending on how much debt you have. But anyway, it's mainly related to the company's owner. So equity holder own a company, right? So that's the financial risk, basically debt, and then divided by equity ratio, D ratio. That's what we're talking about regarding financial risk. Assume a company is 30% debt, which pays 9% interest with its return on equity. If this is 14%, which means return on asset equals to the proportion of debt, 30% times 9% plus 70% times this, right? Since we don't have the economic tax, so we have no tax rate here. Otherwise, we have minus t here. So how do we calculate this cost of equity then? So we can see that. Let me just pull up Excel. Okay. So 30%.9, that would be 27, right? 13%, which is 0.3 times 9. This equals 2.7, right? This part equals 2.7, so we have 14% here. 14% minus 2.7, that would be 11, and then divide by 0.7. We should have 16.14%. So this part is 2.7%, and then 14% minus 2.7% equals to 70% times x, and x is 16.14%, right? According to this provision 2, D ratio, debt equity ratio decreases. It's financial rate. When this decreases, it's required rate of return. So again, it comes back to one formula. Let me pull up the slides. Okay, this is what it looks like. Okay, we draw this, right, and then you just make some modification. You can see the cost of equity equals to this. So when we look at this question, when your debt equity ratio decreases, when DE decreases, right, your cost of equity decreases too. If you feel like, how can I remember this? You don't have to remember this. Remember the debt equity ratio. This is financial risk, right? So as the owner, if the financial risk is very high, you certainly deserve a higher rate of return. However, if the financial risk is lower, which means D ratio is lower, then your required return is lower because you have lower risk, right? So that's another way. For the CFA exam, you certainly need to. I don't like to remember like what I just showed you on the slides. You can remember this. This is really easy to remember, right? Basically, return of assets equals to, right, to debt times the cost of debt plus equity times the cost of equity. This is intuitive, right? As I mentioned in class many times. finance is easy because everything can be derived with logics. And then you can see these logics, right? How much debt, how much equity, and then the proportion of this percentage, right? Times the cost equals to the total cost of the company, which equals to the cost of the assets. And then question 6, what is the amount of annual interest ratio for a firm with $3 million that pays 20% interest if the firm is in 35 tax bracket? Okay, so the money you receive equals to the interest, right? $3 million, right? 3 million times 12%. That's how much interest you paid, and then you save based on the tax, right? So let's calculate this. 12%, 35%, 3 million is equal to this times. We use a calculator to do this, so that will give us A. Okay. So if you can try to remember this DIT, or let me pull up the slides. Also, I covered it. So you can see that the net cash flow, combined cash flow, right? Amount of savings you have are from the tax you paid, and then the tax you paid are also because of the interest is deductible. So basically, in this case, 50,000 times this equals to the difference of those. Let me just go over this again, right? So first of all, you have no debt, right? So that's what it looks like. You have debt 50-50%. Remember, if you have the same amount of assets, then your operating income will not be impacted. That's what it says here. And then this is your pre-tax income, and then this 35% will be taxable, right? So and then you have $50,000 interest, and then that's why, and also it is tax deductible. So that's why your pre-tax income is lower, and then you pay less in tax, and then the money you save is just from tax. Another way to look at it is you have income, right? Let's just say there's EBITDA, right? Minus interest, right? So that's your pre-tax income, right? And then times T. So this is your pre-tax income times T, right? So that's, we have difference here, and then we pay less tax. How much tax we pay? But if this is the same, right, this does not change, then this equals to interest times T. So basically, this minus this equals to 50,000 times 35%. We can double confirm it. Okay, you see that is equal to and then right, those two numbers match. You can see from here, if the first part does not change, we can just ignore it, right? The only difference will be interest times T, and when we come to here, that's, you need to use $3 million times 12% to calculate how much interest we pay, and then times the tax rate. That will just calculate your annual interest, annual saving, because interest is deductible, right? And then because this is only 1 year, right? This question is asking if a company can do this forever, how much can they save, right? So a lot of times we just use TD. So essentially, if you look at what we have, debt times interest times tax rate, right? This is how much you save every year, right? If you can do it forever, we assume that you have a discount rate, right? You can just use interest rate as a discount rate. You can use WACC. But a lot of times to make it easier, because this is a lot of prediction, we just use this as the value of the firm if you have interest savings. So which means you have 10 million times 0.35, right? 3.5 million. That's the total value change. When tax are considered, the value of a leveraged firm equals to the value of the unleveraged firm plus the value of the debt. Plus the value of the debt, now plus the present value of the tax shield. Okay. If we don't think about financial distress, assume that an unleveraged firm changes its capital structure to include 1 million in permanent debt. The tax rate is 35%. The value of the firm will increase by, again, this is 1 million times 35%. Okay, so that's the same as this question. Okay, if the present value of the interest tax shield on debt equals the present value of the cost of financial distress. This is talking about this question. So right here, okay, interest or debt will make you pay interest. Interest is tax deductible. That's why the value of the firm will go up, right? And then if you have a lot of debt, your company can declare bankruptcy. It can be extremely risky. So that's why we have a cost of financial distress. That's why those two will cancel each other out. This is when we achieve the optimal amount of debt. Okay. So that's when you firm is using the optimal level of debt. Okay. When financial disaster is looming, management may borrow to invest in projects have a negative expected net present value because look, if a company is declaring bankruptcy, right? Equity owner have no money anyway. So if a company bankrupted, as a shareholder, you lose everything anyway. So why don't you make something risky? You bet something risky, right? Even though the expected net present value is 0, however, because this is expected means average, right? So you have volatility. Expectation only give you this. So maybe you will just make a really big bet. If you win, you will make a lot of money, so that you have some money. So that's why sometimes they will do it, and then debt holders will have some legal contracts with the shareholders or the company to make sure they cannot do those crazy things. And then we talk about pecking order theory, right? Management will choose to finance with. First of all, they want to use retained earnings first, okay? Because that will impact nobody, okay? And then they will go to debt. So this is 1, 2, 3. The only reason why they don't like new equity issuance is because if a company is issuing new stocks, you will dilute their ownership. Okay, if they use some debt, it is just a little bit more risk, but anyway, it kind of increases the risk mainly to debt holders. Okay. So they prefer that. The second, they think the retained earnings would be the best because it's just the cash they have, and then so right here, so they prefer this. Okay, this is the right choice, debt rather than new equity to avoid a fall in share price. Okay. I think question 13 is a little bit long. Let me try to use Excel, and then I will kind of pause and come back. Excel, and then let me just go over step by step with you guys. You can do this Excel by yourself in the future. So we have 100,000 shares, right? So that's what I have here. 100,000 shares, and then a market value of that will be 5 million. So you can see that this will be $50 a share, right? And then you have the equal amount of debt, which means your debt is also $5 million. Your 1.5 million operating income, so that's what I have here, and then you pay 250,000 in interest. So 250,000 interest, how can we calculate it? What is the interest rate? You can just use this times 5%. You can calculate the interest rate here. So if the company does not pay tax, so that's why we have earnings here, right? What will happen to earnings per share if the firm? So let's look at the earnings per share first, right? So you can use earning will be equal to this minus interest, right? And earnings per share will be equal to earnings per share minus divided by the number of shares. So that's $12.5 originally, right? And then the second part would be it will happen to earnings per share if the firm repurchases 2.5 million shares. So if your company repurchases 2.5 million shares, $2.5 million of shares. Let's assume the stock price stayed the same. Okay, so basically they buy back half, because originally it will be $5 million of the stock value, and then this decreases to 2.5 million, right? So basically you buy back half of the stocks available on the public. So you need money, right? You need to come up with $2.5 million. How can you get the money? Right here, you kind of borrow money, you use debt, you increase your debt. You increase it by $2.5 million, so you kind of borrow $2.5 million from bondholders, right? And then you have cash, right? You use the cash to go to the market to buy back stocks. You buy 50,000 shares back. So that's what happened. So make sure you understand this. And then, because you did not use the company's cash to buy back stocks, you borrow money to buy back stocks, okay? So that's why your operating income will stay the same, because you have the same assets. It does not really change anything of the company's own daily operations. Interest, remember, you need to use debt times 5%. How can we get 5%? We get it from here. We use 250,000 divided by 5 million to get 5%. We assume the interest rate will be the same, okay? And then this is your earnings, right? The same calculation. This will be your earnings per share. So that's why it comes up to 80%. Okay, let me try to select. Let me know if you have any questions. Okay, this is a video, so you should have enough time to pause and then learn what happened. Cost of financial distress. For which of the following firm would you expect the cost of financial distress to be highest? Explain briefly. So basically, which company is the most leveraged? Company software that depends on scale. I mean, a lot of those new startups are all equity financed. Okay, ship company operates a flat or moderate or modern oil tanks. They don't even do oil. Okay, they do tankers. Okay, so it will be very high leverage. Because those companies are very stable, right? The oil price today is like crazy, $20 a barrel. Probably never see that in the history. The last time you see it is 18 years ago. So that's crazy. President Trump said twice it's crazy. Even if the oil price drop, it doesn't really impact them too much, because people still need to have gas, right? And then when they have oil tankers, they just rent out those oil tankers. They don't need to worry about the oil price that much. So that's why they can be very highly leveraged. So that's why they have a higher risk, higher financial risk. Anyway, that's all I have for the quiz of capital structure. I will just not save it. And on Blackboard, let me go to Blackboard here. This applies to all future classes too, okay? Should be able to see that there should be a solution, okay? There is a solution for capital structure here. So for the assignment, you can just refer to the solution if you have any questions, and I just recorded the video for the quiz. So that way you have all the feedbacks, everything you need, and let me know if you have any questions.